Hi guys, welcome to Investing with JYK, and today is gonna be a discussion on long-term returns. So let's first make this thing bigger. So I looked at, wow, ignore the PE ratio, earnings. Found this thing which very conveniently gives us the S&P 500 earnings. 111 basically by the end of 2017. What that means is if you buy the entire index for 2,700 and something dollars, S&P 500. By the way, this is going to be mostly just some almost like a monologue. It's really, I'm just telling you how I think about this stuff. So there's no individual securities we're analyzing here. Okay, so for the price of $2,722, we can buy earning of $111. All right, so that's what we can buy. Now, obviously, that's not stagnant. That will increase. So, what will be the so first of all, we need to establish what is the reasonable future projection of the growth rate. S&P 500 is essentially the majority of the U.S. Economy, so it can not grow faster too much than the U.S. economy. So let's basically we can that basically just means that we can the way I think about it is if we look at the U.S. future GDP growth, that should be over the long periods, let's say over 50 years or something, it should approximate S&P 500 earnings. All right, so we found this nice thing here as some U.S. GDP growth, and one way is we could let's say we could average over this stuff, right? But this is actually the GDP growth nominally. Nominally, it means that it also includes inflation. So taking off the inflation part, you got the real GDP growth, which is somewhat lower. And in fact, you can see since about 2000, it's maybe averages to about 2%. And then if you think about how does GDP even come about, right? GDP, the definition is gross domestic product. So somebody has to produce in this country. That essentially means we just need the number of people producing multiplied by their productivity. That would give us the GDP. So we go to this stuff. So Fred has it has non-farm, but most of the US is non-farm, I think. So for the average hour, for an average person per hour, their productivity will keep growing. Why? Because of technology. Because we, as human, as a nation, as basically a species, we accumulate knowledge that enable us to do things more efficiently. So maybe, 10 years ago, we didn't know how to use, well, 20 years ago, we didn't know how to use Google. Most of us didn't. Now we do. And so that is definitely going to increase our productivity because to solve the same problem, we now need less time. Right? So that this kind of stuff will slowly drive productivity higher, almost always. So I average over this data, and we got is this stuff. The average is 2.1. So per year, we get about 2.1. Oops, where are we? 2% productivity growth, and the other side of the equation is, well, the other part of the equation is essentially working population. So we could substitute just population for that. And where are we? We should be U.S. population growth, right? Stuff's been steadily going down. We're at about 0.7%. So, and also boomers are dying. Millennials may be having babies, maybe they're not. Hopefully they are. But if they're not, it will go down probably to 0 or negative. And if they are, maybe we'll go back to about 1%. So say 0.7. Let's say we stay where we are. So that will give us the projection of GDP growth, essentially the productivity growth plus, well, not plus, but like multiplied by 1. So productivity growth is essentially 1.21, sorry, 021 plus the multiplied by the population growth, let's say 0.07, right, 0.7%, so 0.007, so you end up with 2.8% growth GDP going forward based on long-term productivity growth trends and long-term population growth trends. Okay, so let's plug that number in. So put it here, right, and then project it out to 2066. So what is the meaning of 2066? It's just some random year I selected. It's really that's 50 years after today. So imagine if you are 25 now, that will be 75. Why? About the time you retire. People think they will retire in 60 years old. Very unlikely, because you're going to live longer and you should be working longer. Otherwise, it doesn't work. You know, people used to die at 65-ish. Now they die in 75. So for the 10 years of extra life expectancy, I would expect people to be working a fair portion of that. If only to keep the portion of working life and retirement life approximately the same. Right, so people used to start work at 18 years old or 16 years old until 60, and they will die at 65. So now people start working at 22 because of the university and whatnot, 21, 22, and they die in 75, so maybe you should work until you are like 65. So by the time this current generation retire, their life expectancy might be at, I don't know, 85. So maybe they will work until 75. So that's why I put that number here. But it's not too much of an issue. You can change this number, obviously. So imagine you retire at 75, right? So given $2,722, now you can buy S&P. By the time you retire, how much is your return? How much is that single collection of shares going to earn by the time we retire? 432. And these are after, like, this is basically real earnings. So we get rid of inflation effects from inflation, right? So I think that is if you are into the whole indexing stuff, that is the number you should be watching for. The question should be, given if you're doing like the real long-term investment, you're doing this hold forever until I retire and sell it for 10, 15 years until I die kind of thing. You're buying earnings in 50 years that will be 432, and you're paying 2,700 on that earning, okay? Which means if I'm expecting, say I expect a say I don't sell any assets, but I only, because it may not be anyone that will buy your assets, but the earnings is very likely to be there. So those is always something, because liquidity might disappear. Earning power very likely will still be there. A lot of things that people produce will be needed because people need food, they need their cars, they need, maybe in 50 years you don't need cars, their houses, and whatever entertainment. So these inherently have value, and it's very unlikely that all the economic activity would disappear. But selling, you might not be able to sell, especially during a market downturn, and there's a lot of emotion involved. But earning is a different thing. So you get these earnings, right? And say you want to have a income in the future when you retire, exactly the same as you have now. Let's put the average US income into the number, so 5,500 something. I don't remember, that's somewhat the number, the median. Okay, so given this number, I would divide by 472.46. So you need 127 times that number to get you annual income of this. Right? So then you multiply 2,722. Okay, so that means if you were to sustain your median American life, you basically 50 years before you retire, you need $346,000 in the market, and then you don't have to worry about retirement. Very likely you don't need to worry about that. And yeah, so that's what that's the number I watch for, and I think it's not very attractive because, think about it. You put $346,000 now, and 50 years later, you might be able to, expect $55,000 current dollars per year. That's very, very unattractive. That's basically the reason is PE is very high, and you don't want to buy at really high PEs. And what you want to buy is when you have really low P's. So what do we have here? Really low P's. You got a one here. This is after Second World War, right? Then you got the Nifty 50 somewhere in here. This is the early 1980s when the inflation, they were trying to crush inflation, right? Sorry, Nifty 50 was somewhere in the late 60s, I remember. And then early 80s is the peak of Fed fund rate, so very low valuation. You got huge upside since then. And this is after Second World War, very nice. If you bought here, huge upside. just before 1920, you got a huge upside. And in 1907, after the crash, I remember that was very good too. So valuation really determines your future return. And a lot of times I look at, these things. Long-term US stocks return. Now, if you buy it now, how the hell are you gonna get 6.5% return? Where do you get it from, right? If you consistently, well, this is probably inclusive of inflation. So this is like 4.5% return. But if you think about this, if you are part of the economy, if you consistently outperform the overall economy, you will eventually be larger than the economy. That won't happen. It's mathematically impossible, right? So you're inherently going to be bounded to the size of the economy that you work in. Okay, there will be foreign revenue, international revenue for U.S. Corporates, sure, but again, I would say 6.5% is very overly optimistic if that's what you're buying, the whole index. I do not recommend buying US index at the point. And even if you just think about, the numbers, right? You're spending close to $3,000 and you're buying that $110 of earnings. It's not, you're getting about 3% per year. Yeah, there's some growth. Maybe there's 2%, maybe there's 3% a year. So you get 2-3% year extra per year. But is that really a good deal? I'd rather, get the thing I get the same 110 or slightly more, maybe 113 dollars at 50% off. Stock market frequently will crash 50%. And what that means is you get it 1,500. Now suddenly it becomes a lot more attractive. You get you get 111 or whatever, $120, whatever, and you only pay 15,000, and you get each 110 per year. Very attractive. Now, not so much. So maybe at that point you should pick, you should give up individual stock picking, just buy index funds when the index has crashed 50%. At the current point, I will almost exclusively focus on individual stocks because, yeah, for individual stock you can still find value, but for the overall market, a lot of those are overvalued. I might do a video on some of the things that I think are especially overvalued at some point. But to give you an example of individual stocks that are just undervalued. So I bought in this company. I don't even remember how much I bought it for. It was either 5 or 4 something around those prices. It went up a lot, but this is almost it's mostly a decision on how cheap it is and why people need this, right? So what is this? This is offshore drilling company. I may do another video like detail on this, but essentially it's an offshore drilling company. People need oil for now. and that's not going to change for a decade at least. They were selling at 0.2 or 0.3 PB, right? So the book, they're selling at 30% of the net asset value. Their net asset includes cash and these drilling rigs that you use for offshore drilling. So when we run out of when we run out of oil on the continent, on the land, we have to drill for them in the sea, and this is the stuff that you need. So I bought some of this because it was so cheap, and I figured that people will eventually need these oil rigs to get more oil. So that you could find some of these things that are still offering good value, but overall market, paying $2,700 for $110 of return per year, I find that extremely unattractive, and I do not recommend. This is my personal recommendation. You have to listen to me. I do not recommend these robo advisors because they do blindly just pick the market. It's really stupid at this point. So just Rant. You may not like this. Click dislike if you don't. And if you do like, as always, share this with your friends. Subscribe, click like, all that. See you next time.